Did your old high school friend suddenly text you to grab coffee? Chances are he's about to sell you a whole life insurance policy and spin a fairy tale about infinite banking. Many Americans love fairy tales. They love pretending that they are investing like the ultra rich. But here is the truth. Whole life insurance contracts are incredibly terrible products with exorbitant commission fees, and the returns are usually a dismal 1.5% to 2.2% after costs. Today, we are exposing the real numbers that insurance agents do not want you to know. Let me say this as plainly as possible. Life insurance is insurance. Investing is investing. When you jam those two things together into one Frankenstein product, the only person guaranteed to win is the one collecting the commission. And that is the whole scam wrapped up in one sentence. People do not buy whole life because the math is amazing. They buy whole life because the pitch is emotional, the jargon is confusing, and the product is sold in a way that makes average families feel sophisticated. That is why these policies keep getting pushed. Not because they are efficient, not because they are optimal, not because they are the smartest way to protect your family. They get pushed because complexity is profitable. So let's strip this thing down to the bones. Term life insurance is simple. You pay a small premium for a set number of years. If you die during that term, your family gets the death benefit. If you outlive the term, the policy ends. That's it. No mystery. No fake wealth strategy. No magician smoke. It is just pure insurance. Whole life insurance is different. It combines an insurance policy with a forced savings bucket called cash value. So instead of paying just for the insurance, you are paying for the insurance, the sales commissions, the policy expenses, the internal fees, and a low-return cash value account that gets dressed up like some elite secret wealth machine. It is not elite. It is not secret. And it is definitely not a wealth-building cheat code. It is an expensive, slow, clunky financial product sold to people who are scared, busy, and slightly intimidated by investing. And that is the real game. The industry knows something about human behavior that most people do not want to admit. Most people would rather buy a complicated story than follow a boring plan. Most people would rather feel sophisticated than be effective. Most people would rather say, I have this advanced financial strategy with policy loans and living benefits and tax advantages, than admit the truth, which is that the most reliable path to building wealth is brutally simple. Protect your income with cheap term insurance, then consistently buy productive assets. That's the whole thing. Buy term and invest the difference. Now let's put actual numbers on this because feelings are where people get hustled, but math is where lies go to die. Let's say you have a budget of $100 a month. That is your insurance and investing budget. 100 bucks, not fantasy money, real middle-class money. If you go buy a simple term life policy, maybe it costs you around $7 a month, not 100. 7. So now you still have $93 left over every month. $93. That $93 is where your future lives. Now imagine you take that $93 and you automatically invest it every single month into a low-cost S&P 500 index fund. Nothing sexy. Nothing to brag about at parties. No secret sauce. No leather-bound financial binder. Just an automated contribution into a broad market index fund. Let's assume an 8% annual return over 20 years. What happens? You end up with over $52,000. In fact, with monthly contributions, you are in the ballpark of roughly $54,000 to $55,000. Even if you want to be conservative and haircut the assumption, you are still way ahead. The exact number can wiggle around depending on timing and return assumptions, but the point does not change. You are building real wealth in an actual investment account that you own, control, and can see. Now compare that to the magical cash value pitch of whole life. You put that same $100 a month into a whole life policy for 20 years, and the cash value might crawl its way to around $25,000. Read that again. You gave up $100 a month for 20 years, and the policy gives you a cash value around 25 grand. Meanwhile, the boring investor with the $7 term policy and $93 invested is sitting on more than double that. That gap is not small. That gap is a financial massacre. And here is what makes it even uglier. The whole life buyer usually does not realize how bad the deal is because the product is intentionally designed to hide the pain up front. In the early years, a shocking amount of your premium gets vacuumed out by commissions and policy costs. The policy often has lousy cash value growth at the start because the machine has to feed itself first. Translation: your money is not really working for you in the beginning, it is paying the sales pipeline. This is why these policies get sold with so much poetry and so little clarity. Nobody says, "Hey, I've got an amazing idea. Give me money for 20 years so I can underperform a basic index fund by a mile, lock up your capital, confuse you with policy language, and make it annoying for you to get your own money back." No, they tell you stories. They tell you about certainty. They tell you about discipline. They tell you about tax advantages. They tell you about becoming your own banker. They tell you that wealthy people do this. They tell you it's safer. They tell you it's a legacy tool. They tell you that the stock market is risky. And this is where I need to get a little blunt. A lot of middle-class people get seduced by whole life because it flatters their ego. It makes them feel like they've entered some private financial club. They are no longer just buying index funds like normal people. No, now they have a strategy, a system, a wealth architecture, a policy structure, a private reserve, infinite banking. It sounds fancy. It sounds exclusive. It sounds like something the masses do not understand. Exactly. That is why it sells. Because if I told you the truth, which is buy cheap insurance and automate the leftover money into a low-cost stock index, your eyes might glaze over. It is too simple, too ordinary, too boring, too effective. And boring does not generate fat commissions. Let me paint you a picture. There are two people. The first one is sitting in a coffee shop with an old acquaintance from high school. The acquaintance is suddenly very interested in his family, his goals, his kids, his future, his legacy. He pulls out charts. He starts talking about protection and tax efficiency and guarantees and cash accumulation. He says things like, "This isn't an expense, it's an asset." He throws around phrases like living benefits, policy performance, participating dividends, and wealth preservation. The buyer is nodding, half understanding, half too embarrassed to admit he is lost. He thinks, this must be one of those things smart rich people do. He signs. The second person gets a 20-year term policy for around $7. Then she sets up an automatic transfer of $93 a month into an S&P 500 index fund. She does not brag about it. She does not create a social media post about becoming her own bank. She just automates it and goes to work. 20 years later, who is in a stronger position? The one with the neat binder and the complicated story? Or the one with the actual money? This is what people keep missing. Wealth is not built by sounding smart. It is built by owning productive assets over long periods of time. That is it. Stocks are ownership in businesses. Businesses produce profits. Profits compound. Costs matter. Time matters. Behavior matters. When you reduce fees, stay invested, and let compounding work, you give yourself a real chance. Whole life hijacks that process. It takes money that could have gone into productive assets and reroutes it through a product with layers of friction, layers of fees, and layers of confusion. And if all of that were not bad enough, there is one devastating fact that should end the conversation for most people immediately. When you die, your family typically does not get the death benefit plus the cash value. They get the death benefit. That's it. The cash value you spent decades building up inside the policy does not show up on top as a bonus inheritance. It usually offsets what the insurer pays. In plain English, you spent years stuffing money into this side bucket, and when you die, the insurance company keeps that accumulated value as part of the deal structure. Your heirs do not collect both piles. That is the part that makes people's jaw hit the floor when they finally understand it. Think about how insane that is. You are told that the cash value is this amazing living asset. You are told it grows and can be accessed and borrowed against and used strategically. Fine. But when you die, your family usually just gets the death benefit, not the death benefit plus the entire cash value account you funded for decades. The company effectively absorbs that built-up value. So let's call this what it is. You spent years paying extra for a savings component that your beneficiaries do not get on top of the policy benefit. That is not a gift to your children. That is an expensive gift to the insurance company. And yet people say, I want whole life because I want to save money for my kids. No, you want to save money for your kids, which is a beautiful instinct. That part is honorable, that part is human. Wanting to protect your family, wanting to leave something behind, wanting your children to have more options than you had, that is not stupidity. That is love. But wrapping that love inside a garbage financial product does not make it noble. It makes it costly. If you really want to save for your kids, you do not need an overpriced insurance wrapper with lousy returns. You need actual assets in your name. You need an investment account. You need consistency. You need a plan. You need to stop confusing emotional comfort with financial effectiveness. Because when you buy whole life to save for the kids, what you are often really doing is buying an overpriced policy that enriches the salesperson and starves your family of better alternatives. I'll say it even harsher. For a lot of middle-class families, whole life is not a college plan. It is not a legacy plan. It is not a wealth plan. It is an expensive way to buy your insurance agent a new BMW. That is the truth nobody wants to say out loud because it sounds mean. But mean and true beats polite and false every single time when we are talking about your family's money. Now let's talk about the other sacred cow, infinite banking. This is where the pitch gets especially absurd. The idea sounds seductive. Overfund the policy, build cash value, then borrow against it later for investments, business opportunities, cars, emergencies, whatever. The salesperson frames it like you are using your own money like a private bank. You become financially sovereign, you keep control, you recycle capital, you capture the banking function. Sounds amazing until you remember one tiny detail. You are paying interest to borrow against your own policy. Let me slow that down. They take your money, they let it accumulate slowly, then they let you borrow against it, and they charge you interest, and people clap like they discovered fire. No, that is not financial liberation. That is brilliant marketing. If you have your own money, why would you cheer because a company allows you to access it through a loan structure that charges interest? Why are we acting like this is some heroic power move? You are not becoming your own banker. The insurance company is becoming a payday lender for the middle class while you call it strategy. And before someone jumps in with, well, technically you're borrowing against the cash value, not withdrawing it, yes, I know the mechanics. That does not save the concept. You still owe interest. The loan can reduce your death benefit if not managed properly. If the policy lapses with an outstanding loan, you can trigger nasty tax consequences. And the whole system only looks elegant when it is presented on a whiteboard by someone who earns money when you buy it. In real life, people borrow from these policies because they need liquidity, because they got sold on a dream, or because they are trying to justify a product they already bought. And the tragedy is that the same person would often be in a stronger position if they had simply kept their insurance cheap and built a separate liquid investment portfolio. This is the behavioral trap. People want one product to do everything. They want insurance, investing, tax strategy, forced discipline, emergency access, family legacy, and rich person mystique all in one box. That desire is understandable. Simplicity feels too unsophisticated. But in finance, when one product claims to solve everything, it usually solves one thing really poorly and charges you for the privilege. Let me give you another example. Imagine two parents, both with two kids, both making decent money, both wanting security. Parent A buys whole life because it feels permanent and responsible. The premium is high, but they tell themselves they are building cash value, so it's okay. Every month, more money goes into the policy. They feel disciplined. They feel protected. They feel like they are doing something for the future. But they have less room to invest in retirement accounts, less room to build a brokerage account, less room to handle emergencies. Their wealth building engine is weaker because their cash flow is being siphoned into a slow moving product. Parent B buys a cheap term policy. Then they funnel the rest into tax advantaged retirement accounts and a simple index fund. Over time, they build actual net worth. They have real investment assets. They can see their balances. They have flexibility. Their money is not trapped behind surrender charges, policy illustrations, and loan provisions. They can leave their kids something more powerful than a policy pitch. They can leave them a portfolio, and that is the thing I want burned into your brain. Your kids do not need you to buy financial theater. Your kids need you to build net worth. They do not need a dramatic sales presentation about certainty and leverage and legacy. They need parents who avoid stupid fees, protect income efficiently, invest consistently, and keep more of what they earn. Now, are there rare cases where permanent insurance can have a role? Sure. Extremely high net worth estate planning, special needs planning, specific business arrangements, situations with lifelong dependents, highly specialized cases. Fine. But that is not what gets marketed to most people. That is not the average family sitting in a strip mall coffee shop getting pitched by an eager salesperson with a polished smile and a quota. The average middle-class buyer is not solving a complex estate liquidity problem. They are trying to protect their family and build wealth. For that person, turning life insurance into an investment is usually a terrible move. And let's talk about the emotional manipulation for a second, because this part matters. The whole life pitch often wraps itself in morality. If you really loved your family, you would get permanent coverage. If you were thinking long-term, you would value guarantees. If you were disciplined, you would appreciate forced savings. If you cared about legacy, you would understand the importance of cash value. See what is happening there? Your love gets weaponized. Your fear gets monetized. Your confusion gets converted into premium. That is why you need a rule so simple that nobody can talk you out of it. If someone is trying to sell you insurance as an investment, stop the conversation and separate the functions. Insurance covers risk. Investments build wealth. Once you separate those, the fog clears instantly. Now let's go back to the math one more time, because this is where conviction comes from. $100 a month. Term policy, about $7. Money left to invest, $93. $93 per month at an 8% annual return over 20 years becomes over $52,000, roughly in the mid-50,000 range with monthly compounding. Whole life cash value after 20 years, around $25,000. That means the opportunity cost is not some tiny rounding error. It is tens of thousands of dollars. And if you stretch that timeline to 30 years, the gap gets even more violent, because compounding punishes inefficiency over time. The longer you drag your money through a low-return, high-friction product, the more wealth you quietly destroy. That is what fees do. That is what bad design does. That is what mediocre returns do. They do not usually hit you with one dramatic explosion. They bleed you slowly, quietly, respectably, year after year after year, until one day you wake up and realize you worked hard for decades and somehow built less wealth than the boring person who did the obvious thing. That is why I get so aggressive about this topic, because the harm is not theoretical. It is not academic. It is not just different philosophies. It is real families ending up with less money because they confused complexity with intelligence. Please understand this. Financial products are not automatically good because they are complicated. In fact, in retail finance, complexity is often the camouflage for extraction. The more difficult a product is to compare, the easier it is to overcharge you. The more moving parts it has, the easier it is to hide commissions. The more special it sounds, the more likely somebody is making a fortune selling it. Simplicity threatens the people who profit from confusion. A $7 term policy and an automatic index fund contribution do not make anyone rich except you decades later. There is no giant commission to harvest. There is no long glossary of features to distract you. There is no illusion of insider status. There is just protection and compounding. That is why it works. And let's kill one more myth before we finish. Some people say, but if I buy term and outlive it, I get nothing. Wrong mindset. If you buy homeowners insurance and your house does not burn down, did you get nothing? No, you got protection during the period of risk. That was the job. Insurance is not supposed to be a prize machine. It is supposed to transfer risk. If you buy term life during the years when your family is financially dependent on your income and you do not die during that period, that is a win. You stayed alive? Your family did not need the payout. Meanwhile, you invested the difference and built actual assets. That is not getting nothing. That is getting exactly what you needed. The problem is people want every dollar to multitask. They want to never feel like money is gone. So they get lured into products that pretend to refund the emotional discomfort of paying for insurance. But that refund usually comes at a terrible price. You know what beats trying to make insurance feel like an investment? Actually investing. You know what beats borrowing against your own policy? Owning liquid assets. You know what beats complicated illustrations and policy reviews? A simple monthly habit. You know what leaves a real legacy? Net worth, paid off debt, retirement assets, brokerage accounts, cash reserves, good financial behavior modeled for your kids. That is legacy. Not a convoluted contract with surrender charges and internal moving parts you need a salesperson to re-explain every year. So, if you are watching this and you already bought whole life, do not spiral into shame. That is not useful. The point is not to feel stupid. The point is to wake up, read the policy, understand the surrender value, understand the death benefit, understand whether there are alternatives, figure out what you are paying, what the cash value actually is, what the internal rate of return looks like, and what you are giving up by staying in it. Then make a decision from facts, not from pride. Because pride is another reason people stay trapped. They do not want to admit they got sold. They do not want to tell their spouse the wealth strategy was mostly a commission structure in a suit. They do not want to face the fact that boring people with simple index funds are winning. But the sooner you stop protecting your ego, the sooner you can start protecting your future. And if you have never bought any life insurance at all, here is the practical takeaway. If people depend on your income, get term life. Keep it simple. Keep it cheap. Cover the years of real risk, then invest the difference. Automate it. Ignore the noise. Do not buy products you need a translator to understand. Do not confuse guarantees with good returns. Do not let anyone sell your fear back to you at a premium. Your family deserves protection. They also deserve better than a slow, expensive product pretending to be a wealth plan. The financial industry has mastered one thing: taking ordinary goals and wrapping them in complexity until people think the expensive option must be the smarter option. Do not fall for it. There is no medal for using a more confusing product. There is no trophy for overpaying. There is no bonus point for sounding sophisticated while underperforming. There is just the scoreboard, and on the scoreboard, buy term and invest the difference keeps beating whole life for the vast majority of ordinary families who are trying to build wealth, protect income, and leave something real behind. That is the boring truth. That is the powerful truth. And that is the truth the commission machine hates. Don't let complexity steal your money. Click on this video to see how I set up a super simple S&P 500 index fund portfolio in just 15 minutes.